All right, ladies and gentlemen, and welcome back to another edition, a special edition, if you will, of the EFG Podcast. I'm joined today by my colleague and friend, Michael Clonis. Mike?
Good friend.
Yeah, absolutely. And obviously, I guess everyone probably knows the reason why we're here, ourselves and the viewers included. We're here to talk about the issues in the banking and finance sector.
And in particular, the S banks.
Yeah, the S banks.
Well, the SI banks, which is Silicon Valley Bank.
Yep.
Signature Bank.
Yep.
And Silvergate.
Silvergate, yeah. If you are banking at an institution whose name begins with S and I would get your money out now because
immediately.
Yeah, on pattern recognition, there's something going wrong.
The next one down the list is the letter T.
Yeah. So, do be aware, and I guess we're going to sort of dive into why this is all happening, what we think is going to flow on from this. But before we do, make sure you guys are subscribed. It would really help us out a lot. Give us a like and, leave a comment. We really sort of enjoy reading them. And, again, it helps us out a lot.
I'd probably like to start by talking about why it's happened, and we might all have a fair idea, but there's some details that's peculiar about the American banking system. Big picture, interestingly, a lot of the capital ratio rules, like the net stable funding ratio and the liquidity coverage ratio, only applies in the US to banks with more than $250 billion.
Mm-hmm. In assets?
In assets. So, good point. And what's interesting about that, America has 4,157 commercial banks, which is a lot of banks.
A large amount of banks.
And a lot of banks beginning with the letter S, so we should be very careful.
Look at the list.
We should be very careful with that one. So, but interestingly, these capital ratios only apply for banks above 250 billion, and out of the 4,000 banks, only 13 banks are above 250 billion. So the capital ratio rules don't apply to 4,143. So what are the issues there? Why did Silicon Valley get particularly into trouble? Well, they were using deposit money. So your deposit that you put in the bank, 90% of their money was in at call deposits, and they, of course, went and bought 10-year treasury bonds with it, which I thought was a good idea because when interest rates were zero, they could get 1% from the treasury bonds and pay a little bit of interest to their depositors.
Yep. Make the difference.
It seemed like a good idea at the time. And what happened, of course, for example, the value of the bond went from $100 down to $80 because yields go up, price goes down. Now, what's peculiar about the American accounting rules, ever since 2008, the rules were changed to, I think it's misleading and it's rubbery figures on the accounting side, is that normally on short-term trading assets, what they call ready-for-sale assets, you can mark to market the profit or loss and take that to your profit and loss account.
Absolutely. So what Mike means is as the price changes, that changes in value on your balance sheet.
And the difference goes to your profit and loss.
Yep.
But the value of the SVB assets went down by about $20 billion. And the American accounting rule is you can classify them as long-term assets, term to maturity assets, and the accounting rule is you don't have to declare the loss. It's not in your profit and loss figures. And what the rumours going around last week were from a few of the original investors was that the $20 billion undisclosed loss in those assets, it was greater than their capital base. Technically, they were insolvent. So a lot of the media is talking about how the bank wasn't prudent enough to hedge those interest rates. So here is another accounting peculiarity in the US which discourages banks from hedging. If you put on a hedge, say on the futures, and in theory you made $20 billion on that hedge because it was fully hedged, you have to take that $20 billion to your profit and loss account.
Yep.
And pay tax on it.
Yep.
And you don't take the loss on the long-term assets. You don't take that into your profit and loss. So therefore, you're overstating your profit and loss.
And then paying out tax unnecessarily.
Paying out tax and overblowing.
Yeah.
And obviously, vice versa. The derivatives make a loss. Your bonds make a profit in the opposite scenario. So all of a sudden, your business is going backwards, making a loss, and in actual fact, you actually break even. Now, keeping in mind that I did have a look at the the equity of SVB, and the capital was, I think, only about 16 billion.
Yeah.
And the profit and loss of the company to December just passed was only about 1.6 billion. So it made a 1.6 billion with a hidden $20 billion in losses. So of course the rumours went around, and we had what we call a typical bank run, which is very reminiscent of Jimmy Stewart's What a Wonderful Life, one of my favourite movies, but you should go see the scene. When everybody's rushing into the bank, one bloke asks for $220, and Jimmy Stewart says, "Mate, how much do you really need?" Because your money isn't really invested with all these houses of your friends, and the money's not available. So the issue for SVB is liquidity, and I think the main thing we're dealing with today, and it'll be a lot more on our mind, is liquidity. And the big point I would make is that the US Federal Reserve came in and said every deposit is protected, even the insured depositors above $250,000 were protected. So if you're a depositor at these small banks, you can rest assured, you don't have to take your money out. You are protected by the Federal Reserve. But here's the point about where the danger is. The investors, the shareholders, and say senior commercial bondholders all get nothing.
Yep, nothing back. And, some might say rightly so. But I just wanted to go back and sort of go over the points that you made, because in many ways this was the perfect storm. You had a bank that was right on the edge in terms of size of the capital adequacy requirements. So it's the maximum size it could be before it had to have the improved capital adequacy. You had a bank that was in a sector that saw a lot of drawdowns. So, with the tech space struggling with the higher interest rates.
It was too concentrated to one industry.
And they had a lot of drawdowns from that. You had the accounting rules, which basically meant that if they did invest in long-term US government treasuries, that it was against their interest to hedge that. So you had that as well.
It wasn't just a lack of intelligent risk management. It was they were incentivized not to do it.
Yep, absolutely. And then you had, probably the most rapid, interest rate rise in the last sort of 30, 40 years. And all of those factors really played into this. That's right. It wasn't... you could say that there's elements of, mismanagement or, we don't want to use the negligence word, but
it's been designed by the regulators.
Yeah, exactly.
You got what you paid for.
They're operating in an environment that's telling them how to operate, and they're operating exactly that way. And it was just... the perfect storm. And
if you didn't behave that way, and all your competitors are behaving that way, well, guess what? You fall behind.
Yep, absolutely. And I can't remember who it was who said it, but in the world of banking and finance, it's often said, best to be wrong in the pack than right by yourself.
Absolutely right. It's a bit like, well, there are plenty of stories about if you follow the pack, you can't be wrong. Mm-hmm. But if you're an outlier, you better win, otherwise you're going to get the sack.
Yep.
As I think Peter Morgan found out when he was working for Commonwealth Bank Funds Management many years ago.
Yeah, so look, perfect storm, and then in the modern era, you have something like this, and suddenly everyone makes a video about it. Suddenly all the headlines are about it.
Videos are coming everywhere. Did you notice?
Hopefully, we're a more balanced and perhaps less sensationalized take on it. But you get this great rapid spread of information, and because of everyone's incentives to try and get as many clicks and as many views as possible, they use as sensational and inflammatory and speculatory language.
So we're not going bankrupt?
Well, no, I don't think so. I think as you're sort of saying, this is a liquidity issue. Yeah. And
sorry, didn't mean to talk. The big point you made is Australian banks are safe.
Yeah. So we did want to extend this to Australia, and you look at the capital adequacy requirements that these banks face in the US and compare them to here, and they are, a fair bit different. You look at, the sophistication of, interest rate hedging and stuff, quite a bit different.
Can I make a point that in Europe, those capital ratios, the net stable funding ratio, the liquidity coverage ratio, and there's another one, interest rate risk in banking books, measuring the risk of interest rate movements, apply to 100% of banks in the European Union. So the US banks, probably through their lobbyists, have excluded 4,143 banks from the capital rules, whereas EU are actually doing proper rules.
Yeah, absolutely. I think a lot of people have tried to tie the struggles of Credit Suisse to what's happening in the US banks. And for me, the issues at Credit Suisse are more years of sluggish underperformance due to lower negative interest rate environment, and just it's not a big necessarily immediate blow up due to
this has been going on for 10 years.
A trading loss, really.
And Credit Suisse have moved I think the Financial Review had a good article about how they were pretty big in mergers and acquisition in Australia, but they've moved over to more the personal, the advisory side of things. It's just been a long shakeout, and you just see a lot of the better executive from Credit Suisse moving across to the other banks. So, but that is a long story. But importantly, they came in and said, "Here's $50 billion."
Swiss National Bank.
Yep. Everything's okay. But again, you don't want to be a shareholder.
No.
Because that share price keeps going down.
Yeah. So, we looked, and the default insurance for Credit Suisse is now more than Lehman Brothers when Lehman went under.
Yeah, so before this recent crisis, the Credit Suisse credit default, how much does it cost to insure Credit Suisse? And before, a couple of weeks ago, I think it was about 8% to insure it. And I think that cost has gone up to 30% to insure any of their debt instruments. So you can see at that price, they're effectively out of lending to normal clients at those with that sort of cost of funding behind them.
Yep, absolutely. So bringing it back to Australia, we focus on the Australian market. If you want to discuss the Australian market, give us a call. But a different story for Australian banks and lenders.
Yeah.
Australian banks are very heavy lenders, and unlike the US, where traditionally a lot of the lending is done at fixed rates for long periods, here in Australia, where it is fixed, it's very short term, and over longer term periods it tends to be variable.
I think the next week or two, what we saw out of the interest rate futures market yesterday was all expectations in the Australian market, all expectations of an interest rate increase from the current level disappeared yesterday. It just went, and it was 3.6% for 1 year, 3.6% for 5 years, and about 3.6% for 10 years. So I think if what the RBA does is anybody's guess. Keeping in mind that the ECB did lift by 0.5% last night. So are they staying on the track? The big news next week is the Federal Reserve.
Yep.
Now it's interesting if they go 0.5%. Well, I just step out of its way. If it goes 0.25%, it still means that the Fed's committed to lifting interest rates.
Yep.
I think there are some expectations of no movement at all. So the point is, we don't know. It'll be 50-50 on 0 or 25, I think. And the volatility leading up to that will be fairly high.
Yeah, absolutely. I mean, we're already seeing it. We've seen it for the past week. Interestingly enough, US markets have largely recovered their losses from the whole SVB debacle. Our market's still way down, at least at the time of recording. And then, next Tuesday, Wednesday, we've got the FOMC. I think they'll probably do 0.25%, 25 basis point rate rise, and they'll probably, in their statements, be very much leaning towards, maybe we're going to stop soon, whereas everyone had thought, several more to come. The market's now forecasting maybe one, maybe two more, and then, a pause.
For me, bringing this together as to form my medium-term view is what's happening is that there will be capital leaving, I believe, the smaller banking, the smaller banks, and there'll be less lending coming from the smaller banks. I think it'll be a big bank market. I'd have to say that I believe there's an undertone that the US government is against anything to do with crypto, and there were some rumours about SVB being too involved in crypto and the government too happy to put it into receivership. I believe you will see. I think there is negative government policy on anything crypto in the US.
Yep.
And that sector, like the tobacco sector, like the coal industry, can lose access to capital. Mm-hmm. And I think you need to keep that in the back of your mind as you're allocating assets about. So just to give a quick description of the liquidity coverage ratio, basically it's a calculation the banks have to maintain. It's in their annual reports if you can be bothered looking for it. And it's a calculation that depending on how much retail deposits are good, wholesale deposits under 1 year is no good. Long-term funding from commercial is good, and they weight all these things up and says we must have high-quality liquid assets, i.e., government bonds, and you must have liquidity in liquid government bonds to meet your possible drawdowns over the short term. People taking money out of the deposits. But what does a demand for high liquid assets mean? It means there's a huge demand for government bonds. And if there's a huge demand for government bonds, the collateral pool, I think, will contract. And if there's less collateral in the money system, I think you will see credit growth slow down over the short to medium term, and there's plenty of signs of that happening. Yep. And if there's if there's a credit contraction, and we all know we need the money printed to create the credit to create the money to do the spending. If that's contracting, I think it's negative it points to a slowing down economy. Yep. I won't use the R word. Mm-hmm. So I think the US, European, Australian credit contraction will build up, and I think any asset allocation, I think, must be to high quality assets, high quality and sufficient liquidity rather than anything with a negative cash flow on it.
Absolutely. I don't disagree at all. I think, interestingly enough, you had really strong economic data out of the US in February, and that's probably why they will raise 25 basis points next week. I think March's numbers aren't going to look particularly good, and like you say, credit contraction, we'll probably see a bit more reduction in inflation. That'd be quite deflationary if we saw credit contraction, and that'll probably come into the March numbers, which will be reported in sort of April, and then you'll get the rise next week, but then maybe they won't rise in May. Would be my sort of expectation.
Yeah. I would say 4% would absolutely top any interest rates out for the Australian market.
Yep.
I think at this level, we can learn to live with it. Terrible thing to say. I don't want to demean anybody of the lower incomes who'll be really hurting with these higher mortgage payments. But I think the economy can adjust to these levels. And I just don't see a bad recession out there, but I do see a slowdown.
Yeah, absolutely. I think it does sort of depend on how much further the policymakers go. But I think the cracks that they've been talking about are starting to appear. And hopefully that causes them to take their foot off the brake a little bit.
Remember last week we didn't know what Silicon Valley Bank was, and we had Silicon Valley Bank, had Silvergate, we had Signature, Credit Suisse. Now we've had that in a week, so they're the unknown knowns. Yep. And how much more is out there? If there's 4,140 American banks out there not operating under capital ratios, there's another story out there.
Yeah, the definition of a black swan is you don't expect to see it.
That's right.
You don't expect that it can exist. So, you never know where the next sort of fracture will appear. I do just want to reiterate that I think that the liquidity problems in the banking space can and are being resolved. They can be exacerbated if everyone keeps panicking, because, if you're all sort of running for the exit at once, you're not going to get out in an orderly manner.
The US Federal Reserve, the Australian Reserve Bank, can solve liquidity issues if you are holding government bonds. Mm-hmm. If you are holding corporate paper, you'll have greater issues. Mm-hmm. So I think for the banks, there'll be a flight to assets that are not weighted that highly for use of capital, i.e. mortgages, residential mortgages, less than 80% loan-to-value ratios, and there's another less weighting for mortgages under 65, another one of their ratios. So I think it'd be a fight for assets. The big banks have got the capital and the liquidity. The small banks, we've just seen, and Sammy and I do a bit of institutional hybrid trading, and we just seen that market, like the benchmark hybrid HBRD, that's been marked down to about 10,004, which is about 1% down. It's just showing that the credit spreads are blowing out a bit, I think.
Yep.
So I think it's just time to be cautious with corporate credit.
Yeah, absolutely. And cautious in general. Coming out of all of this, Mike said you want to hold high quality assets. I think in equities, some of the Australian material stocks will really look quite attractive. The China expansion story is back on a little bit. They're simulating this year. Materials prices holding up really well. And then looking towards later, the second half of this decade, there will be real shortages in a lot of, the base metals that these days I think are far, far too cheap. Your coppers, your aluminiums, some of the secondary base metals.
It doesn't appear to be a price for that big ECG movement and government projected policy.
No, absolutely not. And, a lot of the high-grade, easy stuff has been, mined already for a lot of these metals. But, that's probably a story for another time. That's what I'd be focusing on. But I do think that this whole liquidity crisis is being resolved as we speak.
Yeah, we've seen the markets rally this morning. If you hear another one or two closures, sure, that'll affect the market a little bit. But I think the bigger picture is that credit contraction story. The Federal Reserve, incredible what it did on the weekend. It said anybody with more than $250,000 will cover you as well. And I think there was one, was it Oprah Winfrey had about 560 million on deposit with SVB. So so if depositors can feel safe, definitely will stabilise the market.
Yeah, absolutely. You know, you're removing one of the key catalysts for a bank run, and that is fear about your deposit. So yeah.
That's exactly right. Okay, Sam.
Good point to wrap it up.
Good point to wrap it up.
Hopefully you guys enjoyed that one. If you did, let us know. If you didn't, keep it to yourself. If you have any questions, maybe put them in the comment below.
Yeah.
Try and respond or touch base in the next episode. And if you made it this far, thanks for watching. Hope you have a great day.
And talk again.
Speak soon.
See you guys.
Bye.